already completed session number one, which is our kickoff session for part two decision analysis. Okay, so I guess we have not started with the chapter, but we have covered the introduction part of decision analysis, which is the foundation for this particular section. So if I have to quickly recap like what we have discussed in our previous session, basically we have started with what content we need to study in order to complete our three major section. But one is CVP analysis, second one is marginal analysis, and lastly our statistical section, which is pricing. And moving forward, I guess we have discussed about what exactly CVP means, right? Cost to volume profit analysis. And as CVP is a short run tool for managers to take decisions in like day-to-day life business decisions. So in the short run, I don't have any control on my cost. I don't have any control on prices, right? I can't assume that maybe I'll get some discounts from my suppliers, so my cost get reduced, right? Maybe I will build another factory so that my capacity will increase and I can provide some discounts or maybe reduce my cost so that my customer has to pay a lesser uh, price for that particular product. Okay, so this is not the case when we are studying anything for a short run decision making. If we are talking about price is something which is governed by market, which is governed by my competitors in a short run. In a long run, obviously, I can modify my product. Maybe I can integrate some multiple products, make it a bundle, and increase my selling price per unit. But in a shorter run, we have made that assumption that we are gonna use fixed selling price per unit. Maybe I am selling two cans. My selling price per unit will be fixed. Maybe if I am selling 10,000 units to someone, my selling price per unit should be fixed, considering we are into relevant range. After that, I guess we have discussed assumptions we need to make before understanding this CVP model. So we have discussed around seven assumptions. If I have to mention a few important ones are, firstly, we have to ignore time value of money. Okay, if I am getting my revenue on first year, second year, third year, fourth year, it is exactly same. If we discuss this kind of concept in section number E, which is our capital investment decision, we have to discount those cash flows because as our money get depreciate. Okay, so we need to find their present values, right? We have to discount those cash flows. But in section number E, here we have to ignore the time value of money. This is one thing. Then two important assumptions. My total fixed cost should be constant. Okay. What I meant by constant, my fixed cost, unit fixed cost or total fixed cost, they we have to consider them constant. If my production capacity fluctuates, maybe I am making 10 products in my factory for which I have to pay like $50,000 rent. I have to bear this cost even if I'm making 10 products. If I'm making 10,000 products within the same factory, considering it's our relevant range, it's in our capacity, still I'll have to pay $50,000 rent. So you can say my production level fluctuating, but my fixed cost is constant. So that's why total fixed cost, unit fixed cost should be fixed. Now coming back to variable cost, in variable cost again we have unit variable cost and we have total variable cost. Unit variable cost means, let's say we are uh, producing some cans, we are selling some cans. So if one can to produce a can, I have to incur $10 rupees variable cost. Even if I'm producing 10,000, I'll have to bear the same $10 cost, considering I'm not getting any discounts from my suppliers. I am not uh, uh, doing some value engineering to reduce my cost, right, to making my process efficient. So for per can, I'll have to bear a fixed unit variable cost. But total variable cost will fluctuate as my production and my sales fluctuates. Okay, it goes like in a linear way. This is our another assumption, right? Our cost and revenues should be linear. So total variable cost, let's say I'll have to bear $10 for one can, $10 variable cost per unit, right? And I am producing one can only. Okay, so my total variable cost is $10 only. If I have to produce 10 cans, okay, my total variable cost will be 100 rupees and $100, right? So as my production fluctuates, as my production increases or maybe decreases, my total variable cost will increase and decrease. This is our another assumption. And I guess I have mentioned the linear assumption as well. My cost, total cost, and my total revenue should be linear, right? If my total revenue is going 5x, my total cost or maybe variable cost only should be 5x only. I guess we have covered most of the assumptions, most of the important assumptions. You can watch the previous session recording available on the website to get in detail. I guess we have covered most of the things till now. One more thing, one more thing is we have two factors. One is qualitative factor, another one is quantitative factor. So when we are talking about quantitative factors, earlier we have a idea like every uh, price, every US dollar number is considered as quantitative factor. And other than prices, cost prices, profits, revenue, other than this kind of concepts, everything is qualitative. But that's not a case when we are understanding management accountant concepts. So quantitative factors not just include prices, but also includes any kind of number. This is very, very important concept. Okay, you will get this kind of concept tested in your theoretical questions under CVP. So quantitative factors include numbers, okay, not only your prices, revenues. So when I'm talking about numbers, let's say for example, I have made my process efficient because of which, one second, because of which my uh, production cycle reduced to 4 days, from 7 days to 4 days. So I have made uh, my operating cycle, my production cycle shorter by 3 days. So that is again considered as an quantitative factor. But if we are talking about employee morale, if we are talking about work-life balance, if we are talking about employee motivation, everything else should be considered in qualitative factors. I guess we are done with our recap for uh, like our previous section C decision analysis, right? I guess we should move on to some important topics today. I want to start with my CVP analysis. Till now, we haven't started anything with our CVP concepts, our formulas, our how to uh, create income statements, right? Variable costing income statements. Uh, so this session target should be to complete important formulas, to complete at least 30% of our CVP analysis. Okay, let's start with our section. Let me share my screen. Perfect. So we are going to start with our uh, costing methods first. Costing methods. So understand one thing. If we are discussing about costing methods, you should have understanding of like types of whatever types of costing methods available to you. Most of the costing methods you will like get exposed in part one, but in part two, as I guess we have already discussed, we have to use variable costing. I guess most of you already know what variable costing is, but we are gonna discuss everything in detail in this class. So in costing method, I have uh, job order costing, I have full absorption costing, I have ABC costing, and etc. Then I have variable costing. Variable costing. Why we are not using these upper three costing methods, job order, full absorption, ABC costing, and any other costing for our CVP analysis, and why we are using variable costing? You should have that understanding first before going deep in variable costing. If you see any type of costing, let's say under US GAAP, right? We are learning a US specific course. So in US, we don't have any, like in India, we have Indian accounting standards. So in US, we have US GAAP. In India, we use the rules of IFRS, right? Some countries use IFRS, some countries use GAAP. So US basically use US GAAP. They are somewhat similar, but yeah, in few of the concepts, they don't like match with each other. So we have to make some distinction between IFRS and US GAAP. So in US GAAP, if you see, first you have income. Or let me show you with another way, as most of you, I guess, are from commerce background. So you know we have revenue from operations, right? Revenue from operation, net sales minus we have COGS. COGS means cost of goods sold. Cost of goods sold. So whatever cost you have to incur to create your product will come under this COGS. So let's say this is a factory where your products are getting made. You have labor here, you have electricity bill to run this factory, you have raw materials to complete your product. So every cost which is incur to create that product will come under COGS. COGS is also known as product cost. So if you can see the rent here, the rent of the factory in which our products are getting made is a fixed cost. The labor, let's say we are giving them wages, per day wages. So per day wages, it means if I need 10 labor per day, right, on one day, and 50 at the time of packaging. So my variable cost is going up. So we can consider this cost as variable. So you can see it is a combination of fixed cost and variable cost. So there is no distinction in COGS on whether it is a fixed cost, whether it is a variable cost. So we have to separate those overheads cost from COGS. You will learn this in very, very detail in part one. But right now, we have one understanding that in normal income statement, like statutory income statement, like what we have to present in our annual reports to our shareholders, according to US GAAP or IFRS, there is no distinction between fixed cost and variable cost. Perfect. Same goes for job order costing, same goes for full absorption costing, and same goes for ABC costing. That's why for our internal purposes, okay, whatever we are going to learn in our CVV analysis, It's purely for our internal use. Okay, this is just for managers who are going to make decisions, who are going to make decisions for our business. So in variable costing, we have one advantage with us. We can we have a distinction between our fixed cost, no way, fixed cost and our variable cost. I guess I am making sense till now. So right now, I guess it is very, very clear why we are using variable costing and why we are ignoring other costing methods. Because in variable costing, we have an option where we can separately mention variable cost and fixed cost in our income statement. And this is for internal purposes. You can't present this kind of income statement and your financials to your auditors, to your stakeholders, right? You'll have to present it in standard US GAAP format or in India in IFRS format. Perfect. So let's say for variable costing, I have my revenue with me. This is my revenue. Okay, this whole bucket represents revenue, how much I have earned by selling my products. Perfect. To generate this revenue, I also have incurred some cost, some variable cost I am talking about, right? Variable cost, because to sell one product, let's take same example. We are selling one can which cost around $20. So I guess you know one assumption as well. Whatever we are producing, we are going to sell that in the market. Is it is our sixth assumption. No inventory is gonna left in our warehouses. Whatever we are gonna produce, we are gonna sell in the market. Perfect. So if we are producing one product, we are selling one product as well. So when we are selling one can in the market, we are generating $20 of revenue, which is highlighted by this particular bucket. This is my revenue. Now, to generate this revenue to sell that particular can, it's not come like out of nowhere. I have to produce it. I have to incur some cost producing that particular can. So my variable cost, my plastic, right, my labor cost, my electricity generation, whatever is my variable cost, which fluctuates with the level of production I do, is considered as variable cost. So let's assume $10 is my variable cost to produce one unit of can. Now, when I deduct revenue and variable cost, I left with some amount of money. Please understand this concept very, very carefully. It will help you solve many, many questions, many, many practical questions. So this is my revenue, which I generated by selling one can. This is my cost, which I have incurred to produce that one can. And when I uh, subtracted revenue and variable cost, I left with some amount of money. This is not my profit. This is what we called a contribution. This is what we called a contribution. Its full name is like a little bit different, but let's say this is my contribution. Now, why we are calling this leftover a contribution? Because we are going to use this leftover money to fill our two buckets, to fill our two buckets. Now, if I'm producing one can, I got it, my plastic cost me 5 rupees, I got it, my labor cost me another 3 rupees, X variable cost me 2 rupees. So in total, my one can cost me $10 of variable cost. But as we have discussed, I have to pay for my factory, which is my fixed rent. Whether I'm producing a single can, whether I'm producing 10,000, 1 lakh, whatever it is within my relevant range, it doesn't matter, right? Because fixed costs are always gonna be constant. So this is my fixed cost. Let's say it is $500. So why I am calling this leftover a contribution? Because right now I can't uh, name this bucket my profit because I'll have to contribute. Let me pick some other pen. Perfect. Because I'll have to contribute to cover my rest cost. To cover my rest cost. So this leftover money, which we call a contribution, will get uh, contributed to cover my fixed cost. Perfect. Let's say uh, I am selling 50 cans. I am selling 50 cans. So I'll have to multiply everything with 50. 50 cans. This is my units, which I'm selling. This is my selling price per unit, $20 per unit. I'm selling my can. So it is $1,000. My variable cost, again, I'll have to multiply by 50. It is $500. My contribution, which is my leftover, is also $500. Now, I can't keep this $500 in my pocket. I call it contribution. I'll have to contribute it to recover my additional cost, which is my fixed cost. So everything will go transfer into this bucket, and this fixed cost will absorb every contribution we have generated by selling some X number of units. So let's say right now I have $500 to fill this particular bucket, to fill this particular bucket. Now this bucket absorbed everything uh, it can, right? Every penny it can. Now, let's say after recovering all of my cost, if I am still left with money, if I am still left with contribution, so second thing my contribution should do is contribute towards the profit, which is my net income, or I can say operating profit. Net income or operating profit. You will get these two terms interchangeably in your questions. So you have to understand like they are equally same, net income and operating profit. So this is my another bucket which is getting some kind of amount from this bucket, which is the leftover when we are subtracting revenue and variable cost. So let's increase our numbers. Let's say right now I am selling 100 cans. So my revenue is $2,000. I am multiplying 100 with my $20 selling price. Let me erase a few of the things. It looks really, really messy. Okay, I guess we are done. So I am generating $2,000 as my revenue. Now, if I multiply it 100 cans with $10 of variable cost, $1,000 is my variable cost. I have to subtract revenue minus variable cost to generate this bucket amount, which is my contribution. Now, contribution has to do two things. First, first step, okay, and it should be in order. First step to fill this bucket, which is fixed cost. Okay, first step is to fill the fixed cost bucket. After fixed cost absorb everything it can, left rest of the money should get go into our operating profit and net income bucket. So let's say it is $10. If I have to multiply it by 100 cans, it will become $1,000 of contribution. First $1,000 will get absorbed by fixed cost, which is $500, and another rest of the $500 will be considered as my net income and operating profit. This is the whole concept of variable costing, wherein Whatever revenue I am generating, first I have to reduce my variable cost, right? Because it is a cost which I have to incur to produce my products, right? And the leftover money, I call it contribution. Variable costing calls it contribution. Now contribution have to do two things. First, it have to fill the fixed cost bucket, right? It have to fill the fixed cost bucket. As I'm calling it fixed cost, it will gonna remain fixed. So as my level of production increases, right? If you see contribution, it is also fluctuating as my number of unit is increasing 150 100, and we are profitable at 100 cans. So it is also fluctuating with my uh, level of production. Variable cost is also fluctuates with my level of production. Revenue is also fluctuates with my level of production, which is logical. Fixed cost is not gonna change within a relevant range, and operating profit is just a leftover. Whatever is left in contribution margin after recovering my fixed cost is gonna come into my operating profit and net income. This is the concept level. We have a structure, we have a syntax in which we draw this particular income statement, contribution margin income statement, right? This is just for your understanding, like how exactly variable costing works. I guess you have an idea till now what I'm talking about for my variable costing. Perfect. I guess we can move on. Give me a second.